What the Fed just did was a masterful job here. I'm going to explain it, but this will likely help fuel the short-term rally narrative that I had projected after hitting a 10% correction in the S&P 500. Our portfolio's looking amazing today, although obviously we have a long way to go. Let me jump right into it. I want to give you a quick update here. So listen to what Jerome Powell just said as the Fed meeting just concluded a few hours ago.
Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion.
So if you didn't catch it there, or you don't speak Fed speak, basically what he's saying is that they're going to slow the pace of quantitative tightening. And don't worry, even if you're a beginner, I'm going to explain what this is before jumping into the stock market analysis. But earlier this morning, Nick Timiraos, who's a writer from the Wall Street Journal, probably the only writer that I pay attention to there, was talking about how the Fed might put a pause in their balance sheet runoff. Now, here's the Fed's balance sheet. You can see that it was around $4 trillion before the pandemic. We printed an additional $5 trillion, which is what this is. And in order to combat inflation, the Fed decided to let the treasuries expire or run off of their balance sheet. So the Fed, the way that the Fed prints money, right? A lot of people think that they just go to a printer and print it. No. What they do is they create money out of thin air in a computer, send it to the banks and say, hey, banks, give us your treasuries, we'll give you cash for it. And so they're injecting this liquidity out of nowhere, but they're adding treasuries onto their balance sheet. Now, this does a few things. One, it lowers yields, lowers rates, makes money easy, quote unquote, easy money in the economy. And that way, the banks now not only have additional money, but yields are also lower. So you as a consumer get to borrow money, whether you want to buy a house, a boat, a car, you want to start a business. Not only do the banks have now an endless supply of money, but they also, the yields are also slammed to the ground. And so you can borrow money cheaply. This is what fuels the economy or fuels growth in the economy. But unfortunately, when you do it this fast, it also fuels one of the fastest rates of inflation that we've ever seen in our country's history. So in order to combat that, not only did the Fed raise rates, not today, but not only did the Fed go on a rate raising campaign, they were also letting assets run off the balance sheet, meaning they were not going to be buying any more treasuries, and the treasuries that expired, they were just going to leave it at that. And so slowly their balance sheet would run off. Now, I promise I'll get into the stock market analysis, but essentially when you let assets run off the balance sheet and you don't add additional treasuries, this is called quantitative tightening. You are unwinding the path of easy money. When you pause this, which the Fed almost did this morning, they kind of did it. I'll explain more in a second. That's called quantitative easing, right? It's a path to easy money. So if we go back to this, basically the Fed was letting $25 billion a month of treasuries run off of their balance sheet, right? So they're slowly tapering this off. However, what they did today was slow that down from 25 billion to 5 billion. Now, the reason that I say that they've done a masterful job is because instead of cutting, which the Fed absolutely could not cut, it would send the wrong signal if the Fed cut prematurely. They're like, what other tools can we have to maybe help the economy out a little bit and also help bring yields down? So as opposed to cutting rates, which they absolutely cannot do, what they did was slow the path of treasury runoff here, but mind you, they did not slow it to zero. This was a masterful move. They slowed it from 25 billion to 5 billion. Now, this could seem like a distinction without a difference. However, it really is, because it gives the impression that, hey, we're just doing a little bit here. And then we're a very careful Fed. We're just going to do a little bit. We're not going to overdo it. And we'll see what the data comes out as, right? And this allows them so many tools here, because as opposed to just cutting rates or just raising rates or just pausing, what they can do here is, they can slowly, the next wave, they can maybe, that last 5 billion, they can completely pause the balance sheet runoff, right? That may be the next step. Maybe the next step, which I don't recommend, But maybe the next step is then buying treasuries once again and adding to their balance sheet, for instance, right? Or maybe at that point, after that remaining $5 billion, if they take their balance sheet runoff to zero from $5 billion, maybe they can then do a small rate cut. So they're appearing measured here and appearing dovish as well, but not exuberantly dovish, right? So they couldn't cut rates. And this is, in my opinion, was a really masterful way to appear dovish here. So because of that, we had a nice 1% day in the S&P 500, really matching almost exactly what happened on Monday. Now, it's really awesome when our stocks go up, but this was a more significant move to the bond market. As you see, the 10-year yield losing 0.63% today, right? The 10-year yield is coming down. Remember that Trump and Bessent are also focused on yields coming down. So this is sort of like a collective effort by the White House, the Treasury, and the Fed to bring yields down. See, in quantitative tightening measures, when you are making easy money less easy, right? You're making it hard money. You are not buying any assets from the Treasury. You are letting assets roll off aggressively. You're not providing any liquidity to the banks. You're providing less liquidity. When you do that, that increases the supply of Treasuries on the market, right? Because you're not buying them anymore. So when you increase the supply of Treasuries on the market, just like any other commodity or product in life, when you flood the market with that product, price goes down. What happens to yields when the price of bonds go down? Well, we know that bonds prices and bond yields have an inverse relationship. So if bond prices go down, yields go up, which is part of the reason why we saw that sort of reverse effect of yields going up after the Fed cut, is because they were also aggressively letting assets run off their balance sheet, right? But now when they are when they are loosening monetary policy a little bit, we see yields coming down. So just another method of trying to bring yields down in accordance with the White House, the Treasury, and now the Fed. Now, if you guys are fans of this channel, you know that my thesis for the rest of March, after hitting that minus 10% correction, was that we would get a relief rally, something that we haven't seen in an entire month. This was the fifth fastest correction in NFL history. My God. In stock market history. It's not even NFL season. This was the fifth fastest correction in stock market history, right? So I suspected that at some point we would get a relief rally. I thought that it might happen because historically it has happened off the 200-day, but we just kept going down. And we finally saw a relief rally off of here. And again, if you're fans of this channel, you know that we ended up taking longs on the SPY from here, already closed those out. But before today, my target was that the SPY would get to the 200-day, filling this volume imbalance, this gap that you see here. And that may be it for the rally, right? We might chop around some before making a new low in the S&P 500. Now with this, and this is why I was saying, guys, it does not help you to be a perma bear. Yes, things can look grim, right? But when you have cheap stocks in front of you, and I don't mean cheap as in just, hey, look at the price, it's cheap. I mean, when we're looking at the forward PEs of, say, something like a Google, if we go to the valuation section here, you look at the forward PE and it's trading at less than 18. Historically, that is extremely cheap for Google, right? Even the non-forward PE, right? The current PE is less than 20. And you know that the 5-year average is 25 for Google. This lets you know that, hey, you're probably dealing with an undervalued stock here. And we've done this exercise on this channel time and time again. So I don't want to, relitigate this over and over again. But this is why I said you don't know what's going to happen with the White House, the Treasury, and the Fed. You have three extremely strong and inextricably tied forces to the market that can change policy at the drop of a hat, right? Now, I'm not saying that this is the absolute bottom. I still think that we will put in another bottom on the S&P 500 as long as the White House's policy is to attack the 10-year yield and not care about the market for the short term. We also still don't have any data on all of those layoffs, those federal layoffs. Remember, the federal government is the largest employer in the nation. We still don't have updated unemployment numbers reflecting the size of those layoffs or the impact of those layoffs. We also have negative GDP to deal with, right? In April, we will get the actual GDP reading as opposed to this hodgepodge estimate that the Atlanta Fed puts out, which I will give it some credit is quite accurate most of the time. And then in the Discord, I posted this data here showing what happens after 2 consecutive days with 90% or more of stocks advancing, right? We call these 90% upside days, which are very rare. So on Friday, we had one, and on Monday, we had one this week, right? Friday last week, Monday this week. Now you can see here almost always we get a capitulation bottom 2 weeks later. The good news is that 2 months later, 100% green. 1 year later, only one time was it red lower than the second consecutive 90% day. So that would be lower than Monday's price. Only one time in history was it red 1 year later. And when it was red, it was by a marginal amount. So obviously not guaranteed, but I do think that we get a lower low than at least Monday's low. Another thing is today, I would have really liked us to close above Monday's close. So you can see Monday's candle, the follow through candle, right? We closed here on the SPY at 567.15, and today we closed at 567.13. So right around that close, it would have given me a lot more confidence if we closed above it, but we didn't, right? We actually closed below it. So still the jury's out. This volume imbalance here in the 200 MA is still going to be a very strong level, regardless of the Fed news that came out today. But March seasonality, especially after OPEX, which is quad witching, which is on Friday, March 21st, March seasonality usually is pretty good, even in bear markets and corrections. So I do think we will get more of a rally. And like I said, people want these things to happen so fast, right? Everyone wants a V-shaped correction, or if they want the market to drop, they just want it to happen all of a sudden because people are impatient. But if you go back and look at how corrections and bear markets happen, even relief rallies during corrections and bear markets, right? Let's take a look at 2022. The relief rally lasted like 2 weeks here, right? This is the normal behavior, the normal path of behavior. Everyone wants to react to every single daily candle. And if you go to 2018, same thing. 2018, the relief rally off of that correction before dropping further lasted 3 weeks, right? So everyone wants an immediate reaction depending on if they want the market to tank or rally. They want an immediate reaction and they want price to stick to the level that they are hoping, but that's just not the case. So, guys, that I'm realistic. I look at every single data set that I can. I've studied the market for 20 years at this point, 15 to 20 years at this point, right? And it's just not the case that we get V-shaped corrections and that's it, or this is the top, so we're just going to drop all the way down to the absolute bottom. You're going to see relief rallies. You're going to see relief rallies that last, 2 weeks, 3 weeks. You're going to see drops that are unexpected when everybody's like, oh, the market is oversold. This is the oversold bounce. That's it. We're going to all-time highs before making another low. Like, this stuff is going to happen, especially in this type of environment where, you have the White House, the Treasury, and the Fed trying to go after yields. You have the White House and the Treasury openly saying that they don't care about the stock market, openly saying that, if a recession comes, it comes. We've never seen that before, right? These are very strong market forces here. So in conclusion, unless the White House changes policy, I do not think this is the bottom. I do think that we will likely put in another low below Monday's low. I don't think that the recession story is over, especially with the Atlanta Fed still projecting that the GDP is going to be minus 2% for Q1. I don't think that the unemployment story is over, right? I think that we have yet to see the effects of the mass layoffs by the federal government. And last but not least, I don't think the tariff wars are over, which caused a lot of volatility in 2018, and we weren't dealing with any of this in 2018. So very hard for me to say that this is the market bottom, but I promise you this. I'm sure that those of you following this channel, your portfolios looked like absolute rainbows today, right? It was beautiful. These are the types of days that you will see within a year's time, right? After all of this mess is done and the policy is back on economic growth, these are the types of days that you will see day after day after day, your portfolio just going up and up and up and up in a new revitalized bull market because you chose to not be fearful. You chose to take your time. As we said, take your time. You don't have to rush. You chose to evaluate the companies that you really want to own that are offered at a discount. You chose to fill your portfolio with quality stocks, not BS high beta stocks. Obviously, if you want to take a shot and speculate, you could do that with a small portion of your portfolio, but most of your portfolio should be filled with quality stocks. An added bonus, if you took the time to learn how to trade, which is obviously something that we do. I actually day traded today during FOMC. It was a nice 5-figure day that took me a few seconds of being in a trade. So I'll release a follow-up video talking about some more stock analysis going through each individual stock, but I wanted to make a quick video and update you after this Fed meeting. But if you want to trade live with me every day and you want to learn how to trade, click the link in the description. I go live every single morning during market open. You can watch me trade, and that way, that is, in my opinion, the best way to learn is to watch someone actually trading live. If you're only interested in my long-term analysis, what stocks I'm buying, my valuation models, etc., that link is also in the description below. It's a lower tiered membership. Obviously, you don't get to watch me trade live and you don't get the day trades or swing trades, but it's there for those of you that aren't interested in trading because proper investing is something that I wholeheartedly believe in just as much as trading. Trading is how you generate an income. Investing is how you build wealth. Leave a comment down below. Let me think. Leave a comment down below. Let me know if you think this is the market bottom. Do you think that Jerome Powell just came in and saved the day like freaking Superman? Or do you think that there is more pain left in the market? What did you buy recently in the last couple of weeks? Would love to hear from you. Leave it in the comments below. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.